Little more than a week before Treasury's revised ex-date, at the weekend, President Biden and House Speaker McCarthy reached an in-principle deal to raise the debt ceiling. As we record this video, the proposal is before the House of Representatives, and once passed there, it will move to the Senate. Now, joining me to discuss the key terms and the implications of this deal for the US economy and also for FX markets are my two colleagues from the strategy team, Callow and Richard Franulovich. Guys, welcome.
With you.
Now, obviously, it's been quite a stressful and busy time trying to understand, how and when this would all come to pass. But it does seem to be again the case that, a few more days before the ex-date, we again get a deal. I think what's important to think about at the moment is the terms of that deal. What's I think notable to my mind is this is actually quite a long-term deal, as Congress generally works. But also then, what's the implications on the spending side as well?
Yeah, as you say, Elliot, a long-term deal, so it's till January 2025, and that particular date, you might note, is the start of the next presidential term. So whoever's president there will it'll land on their desk. Probably we don't need to revisit this till maybe second or third quarter of 2025. So it is a suspension of the debt limit. It's not a nominal amount. So it does give a fair bit of flexibility, so Treasury will be borrowing plenty. Noting that the underlying budget position is about a deficit around about 5 or 6% of GDP. So certainly it is right that America should be having serious discussions about fiscal policy. I think many of us would think that this is not the best way to do it, with a deadline of a potential default just days away. But what they've really come up with is a compromise to tighten spending, so discretionary or non-defence spending is sort of up flat, then up 1% over the next couple of years. Defence spending up about 3% and then 1% the year after. So modest changes. Certainly would be a slowdown after what we saw with the pandemic, but that's nothing very radical. It's got a few other bits and bobs in it there that each side can maybe sell to their bases, noting that this is very likely it'll be a bipartisan vote, but that means that there's room for dissent on both sides. So you have got at least 30 Republicans who will not vote for it. And we've probably got quite a few Democrats who won't either, but obviously you only need the small majority to get through. So there are a few other things. The Republicans, McCarthy has been very keen to stress that the budget, Biden administration's planned increase in funding for the Internal Revenue Service to chase down the tax evaders. That a lot of that's been ripped out. So that's they're selling that to the Republican base. And in fact, you would have to say that the changes that there are there on the small change in work requirements and so on that makes it slightly more difficult to obtain welfare. These sorts of things it's very hard to see what's in this for the Democrats beyond avoiding a potential economic disaster. So a very grudging support, I would say, from the Democratic side. A number of wins in terms of Republicans' priorities, but that's how they played the game. They're running down the clock so close to the deadline.
Very interesting. So, Rich, if I turn to you, at the moment, the US economy, the labour market's held up quite well, but activity is showing itself to be weakening and quite, I guess, fragile in terms of the impact of policy. What's the fiscal impulse coming from this bill? Should that lead us to be more concerned about the US economy? And a second point I might ask as well is, passing this bill, does that mean this is the end of fiscal uncertainty as we roll through this year, or is there potentially more uncertainty to come?
Yeah, great questions, Elliot. So to the extent we've now got spending freezes legislated in place for the next couple of years, at the margin that makes fiscal policy somewhat tighter than would have otherwise been the case if we didn't have to go through this particular issue. The best estimates are that this particular deal will shave several tenths of a percentage point off US GDP growth over the next year or two. But coming at a time when the US economy is still showing a lot of late cycle wage and inflation pressure, and at a time when the economy is still operating essentially above capacity, albeit with signs of growth weakening, in many ways this plan to a certain degree is supportive of the Fed's goals. But at the same time, let's not forget that the sheer uncertainty that we had around this particular issue would have been a bit of a brake on the economy, and may have somewhat weighed on consumer and business sentiment. So the fact that we've now averted this tail risk of a more disruptive moment, there's also that positive effect just as a countervailing positive to think about as well. But at the end of the day, we're essentially locking in a slightly tighter fiscal stance, and if anything, it's complementing the Fed's goals.
Great. So we mentioned the Fed there a couple of times. Our house view for the FOMC at the moment is for them to be on hold for now and start cutting in December, and quite an aggressive path of rate cuts next year when we see more of the impact of the economy, policy on the economy, I should say, and also what's happening with the banking sector. Sean, how have you seen, I guess, markets kind of change their perspective on the Fed in recent times, and has the debt ceiling been really the driver of that, or have there been other factors?
Yeah, there's always a lot going on with Fed pricing, but clearly they had at least some of the aggressive rate cuts that were priced in for the end of this year as of a month or two ago. At least some of that was potentially from this concern over the debt ceiling. So a lot of that's been unwound, but we've also had some firmer data and indications from the Fed in terms of the Fed rhetoric that they are not inclined to be, not taking rate cuts seriously just yet. So in the past few days, there's just been a little bit taken out in terms of expectations of tightening. So at the previous FOMC meeting, the Fed talked essentially flagged a pause, and markets were starting to doubt that. But just in the past couple of days, they've seemed to be that the pause is still very seen as the base case. There's only about 8 basis points priced in. It's about 20 basis points by July. So there's still that risk of one more hike priced in. But the markets, I guess they've taken, as Rich said, it's less, maybe a little less for the Fed to do in terms of fiscal policy being a little bit tighter, but at least you've removed some of that big concern over a really catastrophic event.
Okay, so still trying to bide their time a little bit and sort of see how things evolve. Rich, if I can turn back to you again, trying to bring all this into, I guess, one view for what this might mean for the US dollar. We've had some continued sort of movements around a range, 101 to about 104, 105. How are you thinking the outlook will evolve from here?
Yeah, my sense here is that the US dollar's recent run high is not completely spent. That move is not yet exhausted. There's a little bit more upside to go. For a couple of reasons. We're clearly on the cusp of implementing a debt ceiling deal, and that's removing a tail risk for the economy, so a negative tail risk. At the same time, there are signs of some late cycle wage inflation pressures still apparent in the US economy through the labour market and even some of the inflation statistics. And the Fed's speak reflects that, in that the centre of the FOMC appears to favour a pause, as Sean was saying, in June, but not necessarily a hard stop or an end to the tightening cycle, much less the prospect of rate cuts. And given that story, it is entirely understandable that the market should have repriced the Fed curve in ways that it's now embracing the prospect of perhaps even tighter policy in the near term. That story is still playing out. It looks like it's got a little further to run, and I would anticipate that should deliver some further tailwinds to the US dollar. I might add, just taking it from a slightly bigger picture global context as well, it appears that some of that reopening rebound momentum that China was enjoying late last year, early this year, is stalling out a little bit, and that's capping Asian currencies versus the US dollar in the near term. And at the same time, there's some signs that perhaps Europe's rebound, courtesy of the steep decline that we're seeing in gasoline prices, energy prices, that provide a bit of an income in terms of trade tailwind for the US economy, that appears to be moderating a little bit as well. So we're just at this interesting juncture where the US is showing a little bit of late cycle resilience, China's disappointing a little bit, and Europe's numbers haven't quite lived up to expectations as well. So there's just a little bit of a recalibration around that's playing to the dollar's favour as well. And I do think that's got a little bit further to run. But just to put an exclamation point on that, I don't think this is the beginnings of a sustained multi-month upswing in the US dollar. I do think at the end of the day, given that US policy is much tighter than in other parts of the world, and we do have the banking stresses still unfolding in the background and tightening credit availability, I think it will be apparent as we get deeper into the second half of this year that signs of disinflation through the US economy will be more apparent, and that'll mean that the Fed could more permanently shift to a longer term pause stance, and that'll take the edge off the US dollar.
Okay. So finally, Sean, back to you. this kind of tension between US developments and maybe a little bit of uncertainty around China, implications for the Australian dollar?
Yeah. No, as Rich was saying there, you've got the near-term strength in the US dollar means other things equal. Aussie-US is lower, and we have seen a breakout to ranges breaking down to the below 65 cents, and that's the lowest since November. So that's a key factor there, but also, as Rich mentioned, this concern in Asia, this a bit disappointment with the recent run of China data tends to be reflected in punishing the Aussie dollar as a bit of a proxy for China and for Asia in general. So near-term weakness, but we're still upbeat in the second half of the year. We think China will get back on its feet, and that a lot of bad news is priced into the Aussie. So we do see recovery. It might just might not feel like it now.
So we need the recovery in sentiment to follow the recovery in growth, and that just takes time.
Yep.
Yeah, okay. Well, thank you both for joining us again. Please head along to Westpac IQ for any sort of further detail on the strategy team and the economics team's views on the outlook as they evolve. We'll see you next time.